Welcome to the quarterly market review for the second quarter of 2016. For much of the second quarter, stock movements weren't out of the ordinary, with most indexes posting gains for the months of April and May. But the end of the quarter brought stomach-churning drama as citizens of the United Kingdom sent markets reeling by voting to leave the European Union, a result that seemed to catch many observers off guard. Fortunately, investors seemed to regain their composure within a couple of days and took advantage of the buying opportunity, pushing most markets back into positive territory by quarter's close. The small caps of the Russell 2000 emerged as the clear winner, with the large caps of the S&P 500 and the Dow following. International stocks managed to eke out a small gain, while the Nasdaq lost a little more than half a point. Brexit notwithstanding, economically the second quarter looked similar to the first, with one exception: jobs. After growing by 215,000 new jobs at the end of the first quarter, the employment sector saw only 38,000 new jobs created in May. At meetings in both April and June, the Federal Reserve Board determined that current interest rate levels are appropriate given the slowing economy. Specifically, board members noted the sluggish employment picture and inflation that remained under the Fed's target rate of 2%. Overall growth in gross domestic product, although still on the rise, slowed in the first quarter to 1.1%, according to the third estimate released by the Bureau of Economic Analysis. Housing regained some strength during the spring. Sales of existing homes were up 4.5% for the year ending May 2016, while sales of new homes were up 8.7% over the same period. Finally, consumer confidence seemed to pick up toward the quarter's end, with the Conference Board Consumer Confidence Index rising to 98.0 in June from May's 92.4. Oil prices were volatile during the quarter, falling to a low of $37 a barrel and rising to a high of $51 before closing at approximately $49. Gas prices were on the rise as consumers entered the summer vacation months, closing the quarter 26 cents higher per gallon than where they started. Treasury yields continued to fall in the second quarter, while gold continued to rise. The 10-year bond lost more than a quarter point, and gold closed about $90 higher per ounce. Although events in the United Kingdom dominated international headlines, China earned notice from the International Monetary Fund. The IMF urged the Asian nation to rein in its corporate debt levels, which are estimated at approximately 145% of China's GDP. Perhaps the most immediate question on the minds of investors is, will Brexit continue to influence market movements? Observers will also want to keep an eye on employment, GDP, and inflation numbers for clues as to how the Fed might act in future meetings. Finally, it'll be interesting to see whether the markets respond to the presidential election as campaigns kick into high gear. You shouldn't rely on this brief summary as financial advice. To determine how market events might affect your own portfolio, be sure to ask questions and seek expert help.